Hello everyone, wish you all a very happy and prosperous 2023 and welcome to our fixed income outlook into the new year. One will recall that at the start of 2022, markets were expecting inflation to inch up and for the central bank to hike rates. Long-term rates had already moved higher far ahead of the commencement of the rate action by the central banks. At that point, central banks were still not showing much concern for inflation. As a matter of fact, Fed was actually still buying bonds under its quantitative easing program. We all know now that inflation hit some record highs in 2022 and central banks followed up with amongst the sharpest rate hike cycle in the recent history. Much in contrast, at the onset of 2023, markets are indicating an impending recession and continued easing in inflation, as is reflected in deeply inverted yield curve in US, for example. Major central banks, on the other hand, are providing pretty hawkish guidance, with most sounding alarm on continued high inflation print, projecting further rate hikes and a higher for longer rate environment. Markets won the face-off quite decisively in 2022, as should be clear from the way the events unfolded. Who of the two sides positioned at two diametrically opposite ends is going to score in 2023 would pretty much summarize outlook for this year. But then, would it be such a decisive victory for markets yet again this time, or would central banks have reworked their models to be correct about being highly cautious in letting guards down? Let's examine some of these issues in a bit more detail. US inflation has, in our view, been a two-part story. First part being impact due to COVID-related disruptions in late 2021, and second being uncertainty caused by conflict between Russia and Ukraine. As reflected in sharp correction in used car and lumber prices, the two signature items that according to analysts contributed most to inflation at its height, COVID-related impact should continue to reflect reversal in coming months. The immediate and maximum impact of geopolitical events in Russia was on fuel and food items. So energy prices have now corrected significantly in last quarter, with crude prices now settling at about $85 to $90 range. They have eased from their recent high of $130 hit in March 2022. Food prices have also begun to stabilize, with wheat prices now just about unchanged over last year at around $790 per bushel, correcting by nearly 45% from its 52-week high of $14.25 in March. Similar is the trend for most major industrial commodities and metals. For example, aluminum prices are down approximately 18% year on year and 38% from 52-week high presently. So to summarize, all things remaining same, one should expect headline inflation numbers to continue to ease in coming months. However, even after declining, the headline numbers would still probably be well above the target of 2% set for Fed. Besides, Fed has also indicated its objective to keep real rates positive for a while to allow for addressing the inflationary concerns at a structural level. Data on growth momentum seems to be pretty mixed. US GDP growth estimates for Q3 calendar year 22 were revised upwards to 3.2% in December 2022 from initial estimates of 2.6% in October. Now that certainly doesn't suggest any immediate recession. While unemployment data is beginning to inch up, but the overall labor market conditions remain pretty strong, notwithstanding massive layoffs by big tech companies of late. Mortgage market index has shown consistent decline from around 600 levels at the start of the year to almost 200 by December. But that can be understood given sharp rise in home financing rates. One needs to always continue monitoring incoming data though very closely to analyze if the recessionary scenario depicted by the inverted yield curve comes alive, as the lagged impact of the recent tightening and tapering out of the post-COVID demand spike may start reflecting in coming quarters. On the domestic front, whilst headline CPI print has already fallen within the tolerance band of the Reserve Bank at 5.88% in December, the core CPI continues to be sticky around 6%. RBI projection is for headline CPI to ease further in coming quarters to about 5%. While risk remains from record high trade deficit and global liquidity withdrawal, a sharp fall in crude prices and a buoyant government revenue, for example GST at around rupees 1.5 trillion December, and a slowing growth momentum does provide a bit of elbow room for the Reserve Bank. MPC has already slowed down the pace of rate hike to 35 basis points in December. Markets are expecting a terminal repo rate in current cycle of around 6.5%. Major part of the tightening by the central banks during 2022 reflected in flattening of yield curves in most markets. In developed markets, for example in US, the curve stands deeply inverted. This as long-term rates had already moved well in advance of this CB action in anticipation. In markets like US, where inflation still remains much higher than target and Fed continues to provide hawkish guidance, long-term rates have refused to inch higher with successive rate hikes, and now the near-term rates are also just tracking the revised policy rate. With major commodity prices well off their recent highs leading to expectation of inflation continuing to ease in 2023, expected slowdown in growth momentum, and with major central banks already slowing down the pace of rate hikes, the expectations remain for a pause in tightening cycle starting second quarter of the calendar 23. Fed may hike couple of more times to get closer to its currently projected target rate of 5% before pausing. Likewise, while a couple more rate hikes are not ruled out from the Reserve Bank, it may turn to pause mode much earlier in sync with the other global central banks. Equally important, it is only fair to assume that being explicitly telegraphed, next few rate hikes are already factored in by the markets. That provides the backdrop for a far more optimistic outlook for 2023. Long-term rate seems to have already peaked in the current cycle. While presently there is no visibility of any trigger for any meaningful easing in these rates, later in the year, environment may turn more favorable if inflation indeed eases or slows down, deepens further. While central banks may seek more evidence, markets are likely to move much in advance. Yield curves are likely to get flatter in emerging markets and remain inverted in developed markets. The environment being volatile and uncertain, one should be ready to reassess the outlook if incoming data indicates otherwise. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.